Hey everyone, good afternoon. Time for condors, calendars, and butterflies. I got to get used to the new name of this class. We're going to talk about one of those today, and in subsequent weeks, we'll talk about others of those too. But I'm glad you're here taking some time out of your day. I see some familiar names in the chat. Glad you're here as well. And I'm joined by James Boyd, who's helping me on the chat. I appreciate James, of course. And those of you who aren't familiar with James, he teaches throughout the week as well. And make sure you check out him both in webcasts and on X. You can follow either of us on X at Brentmore CS, at James Boyd CS. We both post content throughout the week to help supplement your trading knowledge there. So that's the goal. We're going to talk about iron condors today. I'm going to kind of use this as kind of a starter class. This is more of an advanced class. So I'm going to assume you know some of the basics of options here, but we're not going to go too fancy today, but I think we're going to hit some important stuff. So we'll do that. Before we get too far into this, though, let me just mention that options do carry a high level of risk and are not suitable for all investors. And the material today is intended for general informational and educational purposes only. It's not an individual recommendation or personalized investment advice. And short options can be assigned at any time up to expiration, regardless of the in-the-money amount. The paper money software application is provided for educational purposes only. And just remember that when trading options at or near expiration, you must consider the risks specific to such strategy, including lack of liquidity. We always want to consider liquidity, no matter the type of option trade you do. Significant price slippage and volatility, where profits can disappear quickly and turn into losses at or greater than the original investment or initial margin requirement. Hey, just one reason why we often manage these trades and get out before the last few days of your trades is that the gamma risk, the risk of movement, the risk of it going from doing okay to going really bad really quickly, that risk increases at the very end of an option's life there. So there you go. There's no guarantee of an execution of a stop order that is going to be at or near a stop price. And everything we're going to do today is for illustrative purposes only. Past performance is no guarantee of future results. Schwab does not recommend the use of technical analysis as the sole means of investment research. All right, everybody, what we're going to do? Well, let's take a quick look at the market. There was a good question pre-launch of this show about like, hey, the market moved a lot today. How do we prepare for it? And let's just take a look at the market. We're going to talk about a particular strategy, iron condors, and then we'll look at examples to try and illustrate. We always do that, right? We always try and illustrate on the platform with specific examples. This is the market. You can see the nice trend we've had up on the S&P 500. If you want to throw on some moving averages, there's a 20 and 50. Right now, we're below that 20-day moving average. We have a couple hours left in the trading day. Looks like it's likely we'll stay below that for the rest of the day, but you never know. You could look intraday and it goes along and then boom, you get news. So how do you prepare for the news? Well, you don't know what the news is news because we don't know what's going to come out, right? You never know that. But as James addressed in the chat, he mentioned, you prepare. You have, perhaps maybe you use stop orders, even if they're not guaranteed. You diversify your portfolio so that your risk isn't your portfolio isn't going to fall apart for one trade. Remember, when we're doing trades, if you knew the market was just going to go up and continue to go up, then it would be very easy in this market. Everybody would just buy long stock, okay? Or if they want to, or they may even go further. They may even just buy high beta stocks too, right? For those of you who aren't aware, beta is just a measure of how a stock or index or portfolio moves in relationship to a move in the S&P 500. So if you get something high beta and you think the market's going to go up, it'll move up even more. That would be too easy, wouldn't it? The problem is the market doesn't always go up. The other choice, of course, since we're talking about options in this class, is you could just buy a lot of long calls or something. That's directional, very directional, and benefits if the market moves up. Or if you think the market's going to go down, another directional way of doing it is buying long puts, right? That's for a bearish move in the market. But that's not how things go. There's other ways to trade, and that's going to be one thing we're going to talk about today. What if the market is kind of going sideways? Okay. Can we benefit from a movement other than just if the stock goes up or down? Yeah, we can benefit from time decay. Now, sometimes options trades, the time decay hurts you. Sometimes option trades, the time decay can help you. And we're going to talk about one of those where just the daily, day after day, you wake up each day, we want something where the time decay is going to help us. And that's an iron condor. That's what we're going to be looking at. There's different option strategies that do this, but this is that benefit from time decay. But iron condors are certainly one that comes to mind here. So what's an iron condor? An iron condor is just simply a trade where we're going to do a short call vertical above the current price, typically. We're going to do a short put vertical below the current price of whatever stock you're looking at, or you can do it on an index if you wanted. And those two things together make up what we'd call an iron condor. You can enter both legs, both sides at once if you want. You could kind of leg in and do a short put vertical and then later a short call vertical or vice versa. So that's what an iron condor is. But what I want to do here is let's go to, let me do this. Let's just kind of go through iron condors and give you some of the specs on them here. So as I just mentioned, it's a short, and you're going to have to forgive me a little bit today, folks. I broke my finger and I can't type very well. So, so my typing may be a little sloppy on this, and there's a lesson on that. You know how I broke my finger? I was being towed behind a boat, right? I was basically water skiing, wake surfing, if you will. And I fell and I tried to hold on too long. Do you see the analogy in trading with that? Trying to hold, have you ever held on to a trade too long and you got hurt from that? Yeah, I got hurt from it. It was just not smart on my part. But there's your lesson at my expense there. So short put vertical plus a short call vertical there. Okay. So anywho, so that's the basic thing. It's also non-directional. Okay. It's non-directional. Now we can skew it a little bit more bullish, a little more bearish, depending on the depending on what strikes we choose on that. And so there you go. But generally we're just going to consider it a non-directional trade, even though it may be a little bit, but the delta is probably not going to be exactly zero. Okay, put on it that way. But if it starts to, but if you do it and it starts to go up, then the delta is probably going to skew more bearish. And if you start and it goes down, the delta is probably going to skew a little bit more bullish. Damn it, honey says, stop wrestling with Boyd. Boyd would probably pin me immediately, but he's a nice guy, so he wouldn't break any bones on me. So what about the Greeks? It's positive theta. Time decay helps you out on this. Positive theta. It's negative vega. Okay, implied volatility. If implied volatilities go down, it's going to tend to help the trade. If implied volatilities go up, it hurts. It hurts the trade. That's a negative vega trade. So that's an iron condor there. Your max gain. What's your max gain on this? Your max gain is your premium received. Okay, so that's the most you can make. You can lose typically a lot more than you can gain on these. When you're looking at reward to risk ratios on these, it's going to be greater probably. So your max loss, I'll stick with all caps thing since I started with all caps here, is the difference between strikes minus premium. Okay. And let's see, where's your break even? You got two break evens here on this. Your break evens are the put short strike minus the premium. That's one break even. And your call short strike plus the premium. So that's where you're going to figure out your, but now we have the analyze tab. So but that's probably something you should probably know. Okay. Probably something you should know. Okay. And just remember, almost pretty much any option trade, you're kind of balancing between probabilities, particularly iron condors, between probabilities and reward to risk. And so your probability and your reward to risk, they both depend on the strikes you choose. If you do an iron condor where your strikes are very wide, you're increasing your probabilities of success on that. But there's no free lunches, right? There's no free lunches. If you put them real wide, your reward to risk goes downhill on that. Okay, so we try and do a balancing act on that typically. They can be higher probability trades or they can be lower probability trades. It just depends on the strikes that you're going to do. Now, if you want to make them more high probability, or for our purposes, what we're going to do is I'm going to look for the probability in the money on each side to be about 20%. Okay, that's not an absolute. We can go differ. You can use delta sometimes for that too. Delta tells us how much an option is going to move in relationship to a stock, a $1 move in the stock. But so you can use delta. You can use probability in the money because delta is going to be pretty close, roughly pretty close to the in the money probability in the money stat. And so if we do that on both sides, if you think about it this way, if you have a short call vertical and your probability in the money on the short call is, say, 20%, and you have a short put vertical and your probability in the money of that short put is about 20%, that means you're going to be kind of roughly 60% of them being out of the money of both sides, total. And so that would be a higher probability trade. So that's why I'm picking that 20% level. Very often on like a short put vertical or short call vertical, if we were just doing that alone without the intention of making an iron condor, a lot of times we'll do maybe, a 35% probability. But if you did that with an iron condor and you had 35% probability in the money on that, and you had 35% in the probability in the money on the short put vertical, what does that leave you? That leaves you about 30% probability of it being in between the two, which is not the situation typically people go for on these iron condors here. So let me just finish. I got a few more, and then we'll look at some examples because I want to look at examples here. Okay, when are we going to get out? Well, we're going to get out exit. And remember, it doesn't matter the option strategy you do, have exit ideas in mind before you trade. When you enter the trade, have an idea of when you're going to get out. And have an idea if things are going well, if things are kind of just going so-so okay, or if they're going bad. So if it's out of the money, we're going to, well, first of all, what I would say is manage short put vertical and short call vertical separately. Okay. So if the stock starts going up, the short put vertical is probably going to be doing pretty well. The short call vertical is not going to be doing so well, and vice versa. Just because you entered as an iron condor doesn't mean you need to exit as an iron condor. Maybe you just exit one side at a time. Okay. If you've made 80% on a side, exit. Okay, so that's a good scenario. If you're under 10 days to expiration, okay, about a week to expiration, maybe 5 days to expiration, maybe, but don't wait until the last day typically on these because of that risk I talked about earlier. Exit. So maybe maybe it's not going great. You're not making a lot of money. Maybe you are, whatever. You're going to get out once we get under that 10-day mark regardless. Okay. And we're going to, if it does start to go south, exit on technical breakdown. So what's a technical breakdown? What I mean by that is, let's say we're counting on a support level to hold or a resistance level to hold, and it breaks well through that, you may just look to get out of the side because you were neutral. You entered this trade in the neutral because you're neutral in the stock. Well, at that point, it's probably going to change. And I have one more here, and that is just in terms of money management, probably risking 1 to 2% of active trading portfolio. In other words, when you're figuring out that money management on the trade, you may have maybe you have an IRA or a 401k or whatever. We're not considering, those long-term, non-active, perhaps managed monies. You're probably not factoring that in there. Okay. So there's your rules. There's some, and I don't mean them to be absolute rules. There's obviously a lot of wiggle room different people can do on them, but these are the rules that we're using in this webcast here. Okay. So there's your money management on that. Now let's look at some examples because, I mentioned it's non-directional. How are we going to get non-directional? Well, we're probably going to use your technical analysis stuff that you're used to using. So for example, when we're talking about technical analysis, what are we looking at? Let's go to, number one, I think a lot of technicians would say, well, first thing you see is trend. Okay, that may be something we're going to consider. Probably not super strong trending unless you think that trend is going to end for some reason. Okay, and not necessarily reverse significantly, but just kind of maybe consolidate. But sometimes stocks do that. They go up a little ways and you go, wow, that's gone up really quick. Maybe it's going to consolidate. So trend would be something. Support and resistance levels are clearly, I think, for most technicians, something they're going to look at for iron condors. Stocks that are in channels, great. Maybe if haven't established a channel yet, that's still possible, but look for that support and resistance level. Okay. So let's see. Now, when I say support and resistance level, Chris mentioned something. Chris said, well, what about, how much of a break is it? When do we get out of that? Like, let's say we have a channeling stock. Let me pull up one. Okay, hold on. Let me get out of that and that. And let's look at Cisco. I think that's channeling if I remember correctly. CSCO. Okay, so here's Cisco. More or less channeling. We kind of had a resistance here, perhaps. We had a support down here, and it started to get out of the slot there and back in. Okay, so now after today, could you see why someone maybe comes up with more of a neutral strategy on this, a neutral idea on this? I could see that. I think in terms of trend, there's not really much in the way of a trend. Okay. If you want help with trend, you could always look at, your moving averages. I don't care what moving averages you use. This is a 20 and a 50-day moving average. They're both, well, certainly the 50 days going sideways, the 20 days sloping up a little bit, but when we factor, typically these are going to be sloping up a little bit or down a little bit and not exactly flat. So you got to use it in concordance with like support and resistance levels here. So that's where my neutral bias is coming from on this. When's earnings? We're about to hit earnings season, everybody. Next week, I think, we got big banks kicking off earnings next week. Next earnings, I don't see it on the chart right here. I could add more space there. You can just go here and count out 3 months, and that's probably going to give you within a day or two of it. Or you can always go to the Analyze tab, earnings, sub-tab. November 12th is earnings on it. So that may play a factor in there. If you have a support level or a resistance level, remember they're areas. They're not exact prices. So just because it breaks out, you can give it a little wiggle room on this. You can give it a few percent wiggle room. And the one reason is it's not like the trade goes from good to max loss as soon as we get out of our zone there. It's iron condors are slower moving trades. And that can be great if things aren't going very well, but it can also be really, really frustrating if things are going really well. Because I'll tell you my common experience I've had with iron condors, when I've done iron condors, is I'll get in and maybe the stock cooperates and it's going, hey, this stock is neutral. It's going great. It's been a couple weeks and it's still neutral. And I look at my PL open and I'm up $12 or something like that. They're really, it can be really, if you're an impatient person, iron condors may not be the trade for you, is kind of the bottom line. That can be kind of not a great thing, the slowness, but at times you'll be grateful when the things aren't going very well and you look and you go, oh, this isn't looking very good, but I've only lost $15 on it or something like that. So that's how we do that. So I would say give it a few percent outside of your support or resistance level on that. And part of it, yeah. So I guess that's how I would do that. Maybe 3%, something like that. Again, these aren't solid things. And also, if it goes up and is kind of hovering there for a sec, that's probably okay. If it's going up and there's a lot of upward momentum, maybe you'd be a little quicker to hit the exits here. Now, if our stock is here, where's our stock? 68.63. And I put my strikes, where am I going to put my strikes, I guess is the question. Well, I can go just equidistance between the two, or I could say, hey, look, I'm kind of looking at this as a channel here. My line's a little crooked. And I'm willing to go a little bit closer on my short call vertical. It'll bring in some more premium, but it could go against me more than my short put vertical. At a certain point, you look at the short put vertical down here, and if you put it below support, you go, I'm not getting enough premium even to make it worth it to do that, at which point you would leg in. So you can enter both sides at once, or you can leg in. In this case, let's just look at the trade here. And again, we're going to consider liquidity as well. So let me just think. We got resistance around 69.5. Let me just jot that down real quick. 69.5 is resistance. Support around 66. 66 is support. Let's go here. Let's look at our 20 deltas. And we said earnings. I forgot when earnings were. Earnings were November 12th. So if I want to avoid earnings, which you don't have to do, but I would go before November 12th. Okay. So here we go. I'm going to go to November 7th. Now, if you don't hold before earnings, it's going to tend to keep the implied volatilities high, and it's going to mean it's going to it means it's going to you're probably not going to be able to see as many gains as you otherwise would. Now, Chris said leg in on the closest side of the price. Yeah, generally you'd leg in on the closest side of the price. Here's why. Okay, let's say you have a channel. It's a good question Chris brings up. Let's bring this up. Okay, here's our stock. Okay, this is our channel. Okay, and our stock's up here, and it's coming down here. Okay, and we decide, hey, I want to do a short call vertical up here and a short put vertical down here. And I'm legging in. If my expectation is this stock is going to go down, it probably wouldn't make sense to do a short put vertical initially. We're holding off on the short call verticals because we're talking about legging in here. It probably wouldn't make sense to do the short put vertical right now, because then I'm doing a bullish trade, because remember, this is bullish, right when this is going down, when I think this is going to go down. Now, I may be wrong, and it may not go down, but that's my expectation, is it's going to go down. Furthermore, the premium I would bring in would be very little at this point. Whereas if instead what I did was leg into the short call vertical, the stock's closer to it, so I'm going to get a better premium, and I'm doing a bearish trade when I think the stock is going to go down. Now, we are a little bit closer to the danger area. You're right, absolutely. So maybe that's a concern for you, but we'll just exit quicker if our resistance is broken on that. All right? So I'm hoping that answers your question there, Chris. And I think the reason I took a little detour to answer that is because I think it's a question a lot of people have on that, probably. But let's look at this one here. We're at Cisco. We have our resistance, we have our support. I'm going to go out before expiration. How far am I going out? Just as kind of a default, I'm going to say maybe a month. We'll go less than that often. We can go more than that. And of course, earnings may affect that. But if we can go out near a month, I'm going to go to the month. Remember, this is a positive theta trade, time decay is helping us out. So if we can get something and hold on to it for a little while, that's great. So let me go. I have a probability in the money column here. Let me go down. We said resistance around $69. So we'd want our short strike to be above the $69 level. Well, we got this one, but that's a 38%. So we may go a little bit higher on this. If I were just to go to the 20%, well, there's nothing 20%. The closest to 20% would be this. But because I think the stock is headed down, I'm going to move it up from the 20%. I'm going to go to this about 24, 25%. I'm going to look to sell this one. I'm just going to go one wide on this. So I'm going to sell that, and I'm going to hold down my control key and buy that. Okay, I'm going to hold on to this for a sec. Now, what about the put side of things? If I go to the put side, and we said we went to 20%, this is where we would be. But look, is this going to be enough premium if we go down to the 66 level? Well, let's look at the 66 level. Yeah, that's still probably in the money of 30%. So yeah, we're clear on this. If our support is 66, we can go close to that 20% level. And I'm just going to, now look, we've got kind of a bigger spread on this. That's a little bit of a concern here on this one here. Um, Open interest, 37 contracts. That's probably a correlation there between our open interest on this and that. If I move it up a little bit, I'm getting better spreads on this. So I'm going to go to 66. This is going to be a lower probability iron condor. And I overwrote the other one. This is going to be a lower probability iron condor, but it's going to be a higher return iron condor on this. Okay. Now, how much am I risking? Well, you can always confirm and send to look. I'm risking $55 on this trade. Remember, on iron condors, you're almost always going to be risking more than your max profit on that. That's just kind of how it is. However, we're usually, if you follow the rules that we established, I can't make any guarantees, but if you follow the rules that you established, usually you're not going to be taking a max loss. Okay. If you're getting out 10 days or a week before expiration, you're probably not going to be taking a max loss on the trade. And remember, this can profit, we can only lose on one side or the other at a given time on this. Okay. At any given time, we can only be down on the call side or the put side, or we're likely to only be down on the call side or the put side at once. Because if one side's going well, the other side's probably doing a pretty well there. Okay. I guess again, I can't make any guarantees, which is why it's important to trade liquid stocks here on this. And there we go. But we're risking 55. So can I do more than? I mean, that's something a smaller portfolio could probably withstand. I can increase that. And every contract I increase, obviously, that's just going to multiply the number. So this would be risking about $200 on this trade here. I'm going to put this in, and I'm going to go off the mid price just a little bit, just to try and get a fill. But I don't want to go all the way down to the natural price. Okay, because I'd probably fill on the natural price, but that's a big difference between 28 cents and say like 40 cents or something like that. I'm going to confirm and send, and I'm going to put that in my iron condors group. And remember, once we have that, it just filled. Once we have that trade, we will then look at it as a put vertical and a call vertical on that. A put vertical and a call vertical. We'll manage them as separate trades. Now let's look at some others, okay? I don't want to spend too much time on just one trade. Let's look at Oracle. You know, when you look in, I mentioned support and resistance and trend. In this case, you can see it was trending up. We kind of gapped up, and since then we've kind of been foundering a little bit here. If you go, you may use other indicators as well, like volume profile is very common for these things. For those of you not familiar with volume profiles, what it does is basically it's telling you where the volume has been. Okay. Now I'm on a 6-month chart here. Let me go out a little bit farther on this chart. Let me just go to a 9-month chart. Let me get a little more volume in there. So over the last 9 months, of course, you could use volume at the bottom of the chart if you want, but this is saying this is basically zero volume, and then volume peaked out kind of at these prices. And then it kind of peaked out down here for a while. And it peaked out down here. So this is kind of a trimodal volume profile here on this. The one I'm going to focus on is the one I'm in, though. If the stock is, the theory is this, the stock is going to tend to trade at areas where it's traded more times in the past. So it's traded in this area more times in the past. It's traded in this area more times in the past, and down here. Well, I'm not going to worry about down here. For it to get down here, it's got to go all the way through this one. But right now, we're right kind of in the middle of this one. So So some traders will say the stock is more likely to stay there. You don't necessarily go exclusively off volume profile, but if I have what I would deem to be a support level here, can you see why I may consider that a support level there? And if I have kind of a resistance level up here, can you see why I'd kind of consider that maybe a resistance level up there? If you believe that, then maybe we do this trade this way. Now, if you think this may shimmy up a little bit more towards up a little bit higher, but not up here, we can always skew our strikes up a little bit on this. Okay. Now, this certainly was trending up. It jumped up on an earnings, maybe overshot the mark perhaps a little bit. That seems to be how the market's correct is saying that. But right now, I'm going with my support, with my resistance on this there. Okay. So there's my trade. Let's follow the same rules that we mentioned before. How far are we going to go out? Well, I'm going to go out about a month unless I have earnings that are going to interfere with this. Well, this is going to be an earnings here. That's on December 5th. So earnings probably aren't going to be an issue on this one. So again, I'll go here. Now, sometimes when you look at it, you may go, you can go a little bit longer. If you have liquidity issues on one, typically if you go to the monthly contracts, you'll have better liquidity. More open interest on them, tighter bid-ask spreads on them. I'm going to go just kind of stock generic. 335 is my 20% probability. And I'm going to just click on my bid price. I'm going to go to the next strike up, which is $5 up. I'm going to control click on the ask price. I'm going to go down to my 20% probability or something around there. 19.6, we'll call that close enough. I'm going to click on the bid price. I control clicked. I held down the control key. And then I'm going to control click on the ask price. Okay. Where's my short strikes? My short strikes are 255 and 335. Where do I want the stock to stay between? 255 and 335. Does that make sense for this chart? 255 is roughly here. Okay, roughly there. 335 is roughly here. Okay. I think that makes sense. The stock is more or less in the middle there. So my delta is not going to be huge. It'll be something. If we look at this trade and I right click and I click on analyze trade and I go to risk profile, this is what an iron condor looks like on these. Okay, let me just kind of scooch this in. We can go and we can say, let me just see what my expiration was November 7th. November 8th, that's good. Let me set my slices to break even. And you can see, is this a higher probability trade? Yeah, this is about a 66%, 67% probability on this. Great. Is this a positive reward to risk ratio? No, it's not. If this is my break even, this is our peak, our gain is a lot closer to our break even than our potential loss on that break even. But notice this. This is our max loss represented right here on this. Look at the purple line. That's what it looks like today. The difference between these two represents our time decay on this. If I'm in the zone, okay, if I'm in the middle here, the purple line as time progresses is going to go up. Okay, purple line goes up as time progresses on this. That's positive theta there. And when we say it's a positive theta trade, that is true to an extent. It's not true. It's true where we're starting it out. It's true right here. But if the stock goes over here or over here, what's the what's the purple line doing? It's going down over there, down over there. That means your theta is going to be negative in those situations. So if I were to look at this and I were to go, what if let me go set slices, up 10%, down 10%. Actually, I'm going to move those out further. Let's go up a standard deviation, down a standard deviation. There we go. Okay. So here's our standard deviation move on this. You can see it's shaded with the lighter color in here. Okay. Darker color out there. There's a standard deviation move. There's a standard deviation move. Our theta is still positive going out there. Time decay is still helping us on those, which means if the stock moves quickly, we may not be profitable, but time decay isn't going to kill us right away. Eventually, though, if I look at these strikes out further, let's go out here or go out here, okay? Notice our theta turns negative. Our time decay turns negative on there. So that's there's another potential example trade on this that we can put in. I'm going to put this trade in. Could I put an automatic exit in? I can. I could say, look, if this stock is going to break, well, look, my resistance is around, what do we say, about 329. Say it goes up to about 340, I'm going to get out. Or down to about 270, we'll get out. Can you do that? Yes. I'm going to do another contract here. I'm going to make this a first triggers sequential order. I'm going to right click. I'm going to create an opposite order. This trade is to get me in. All these orders are just opposite those initial orders. They would get me out. I'm going to make it a market order, good till canceled, and I'm going to click on the gear, and I'm going to say, I want to get out if Oracle marks less than or equal to whatever you deem the support level minus a few percent. In this case, I'm going to say 270. Or if Oracle marks greater than or equal to whatever I deem the resistance level plus a few percent. I'm going to say 340 in this case. This is going to automate my exit here on this trade. Now, remember, that's not the only exit we're going to do. We're going to exit if we get to be less than 10 days till go to expiration. We're going to exit if, and we may, if things are kind of breaking down on one side and we did put in the automated exit, we may not get out of the other side. You know, you can cancel it. If you want to automate it, you can do it that way. But really, primarily in this webcast, what we do is I'm just going to manage one side at a time. But if you want to exit the whole shebang here, you can do it that way. So that's kind of an illustration of that, if you wanted to do that. Let me send that order. Now, let's look at, I just want to, as I'm wrapping up, because I just have a couple minutes here, I just want to look at a couple other examples of trades that maybe you'd consider, maybe not, as you want to practice these. I was looking at Alphabet. Alphabet's kind of the similar situation. We have a trend, and so generally on trends, maybe not iron condor material, we do have a lower high on here and equal or maybe slightly lower low. So maybe that's in question. I don't know if that's one we'd look at. What about CCL, Carnival Cruise Lines? The liquidity may be a little bit iffy on this one, so you'll probably want to double check that. But we had a trend, but I would say at this point that trend is broken. You can use your volume profile if you want. You could also do this. You could also say, hey, I've got a support level down here. I've got a resistance level up here. This may be one where you would consider looking for a bounce, legging in a short put vertical, and then if the stock cooperates and it goes up, and then once it goes up and you can get a bigger premium, then you can consider legging in the short put call vertical and completing the iron condor at that point there. And I was also going to show you possibility mRNA, but I'm out of time, folks. So as more of a traditional kind of sideways move, not trending on mRNA. All right, everybody. Hey, thanks for joining me today. I appreciate it. This was Iron Condors today. We'll go to other types of trades in subsequent weeks. I appreciate you joining me. I appreciate James for helping me out in the chat. And make sure you subscribe to that Trader Talks channel. Coming up next, we've got market and sector analysis. That's at the top of the hour. And everybody have a nice weekend ahead. We'll talk to you the same time next week. Bye-bye, everybody.